Hey everyone, welcome back to another Grand Union Finance market update, mortgage market, finance market update with me and Shanelle. Obviously we're going to be talking about a few different things today that are going on in the market, particularly the Bank of England's base rate announcement last week. But before we get into that, if you're new to the channel, please subscribe. There is a big red button down below and also click the like button as it helps us grow our channel. But let's kick off, Shanelle, with the news from the Bank of England last week, which was that we were going to keep the base rate at 5.25%. Good news, bad news? What do you think?
Well, it's good news for me because whenever it changes, it just causes chaos in my day. Because it just, in my week, in my month, because it just chops and changes interest rates. As much as we know it doesn't have a direct correlation to it, but there are, they do look at the news, and it does sort of have an effect on the way that
it's all
rates
confidence, isn't it?
That's it, yeah. So knowing that it stayed stable, it's sort of given us an idea of what's to come, which was that we thought it would rise, then it would plateau, and then hopefully start coming down. So yeah, fingers crossed it either stays the same or comes down now moving forward.
Yeah.
And that's good news for everyone, I guess.
Yeah. We should point out, there was still 3 members of the 9-person committee that voted to put it up to 5.5%.
Yeah.
So I think that does, and Andrew Bailey came out, the governor of the Bank of England, and did say afterwards, don't write off another base rate increase.
Yeah.
Now, I don't know whether he's just doing that to try and just keep everyone
on their toes.
on their toes, yeah, a little bit calmer, because if he's coming out and, or when it does happen, it will be like predicted, you know, because it's already been said. But one thing that both he and Jeremy Hunt, Chancellor, came out and said off the back of it as well was this news, they believe that it shows that the Bank of England's base rate policy is working.
Yeah.
Because they are now predicting, I think I read it somewhere, that one of the best predictions, or the best outcome of a prediction for the rate of inflation, which will be announced later this month for October's figures, down at 4.8%,
yeah,
down off 6.7%. That would be a monumental shift, and I'd be absolutely shocked if it did get down that low.
Yeah.
But it would mean that the Conservatives hit their target that they wanted to hit by the end of the year, which was good for the economy. But they're basically saying, right, the base rate, this is working, therefore we need to keep it here for a prolonged period of time now.
Yeah.
And you know, because the rate of inflation has been stubborn for about 4 months now. I think it's gone from, in the last 4 months, it's been 7.1 to 6.7. Not a huge shift. So you know, they are starting to say, well, it is starting to work, but now's not the time to pull off the brakes. So. Yeah. From a mortgage market perspective, what that says to me is where rates are right now are roughly where they're probably going to be for the next 12 months.
Yeah, and that's it. And we saw quite a big shift in the rate of inflation when they started. You know, they bashed out. They increased the rate massively. They did what they needed to do to really shake things up. So yeah, it played its part and brought can't get my words out now, brought inflation down. And yeah, like you said, it's going to be a slow and steady go now back down to, well, I say back down to what we used to, but is it going to come back down? Who knows?
Yeah, I think we've certainly seen, I think next year that we're not going to get probably as many rate reductions as probably a lot of people are hoping for. Yeah. So I think, number one, if you've got a remortgage coming up in the next 6 months, I can't see the average rate changing. So holding on and sitting on your standard variable rate for a period of time is probably not going to really make too much difference.
Yeah.
Off the back of the Bank of England base rate announcement, we've seen quite a lot of tracker rates fall away from the market, which, to be honest with you, if I was getting a mortgage right now, a month ago we were talking about trackers. Now, less so. With the base rate probably not going to be coming down by more than 0.5% in the next 12 months to maybe even 18 months, a tracker rate just looks a little bit less enticing, because generally they are at the moment a little bit higher than fixed rate. So sticking yourself on a new 2-year fixed rate right now is probably for most people not the worst option. Obviously, speak to a good broker like Grand Union Finance if you do need any help with this, but that's kind of probably where things are going right now. But
Yeah.
I also think from a house price perspective, and this is where we start talking about opportunities for investors, are we now going to see a prolonged period of relatively high interest rates, a longer period of buyers being outpriced by the market from a mortgage perspective, which is going to force the price of property in the UK to come down so that it can get back to a place where the standard Joe Bloggs on the street can actually afford to get a mortgage. So there's a lot to be said about whether or not the house prices are going to start coming down. We've literally just had Halifax come out and say that month on month the average has gone up by 1.1%. So it's really difficult to determine, but certainly I don't think we're going to see some huge boom in property prices in 2024. So that obviously opens up opportunities for investors, because I always say purchase price is permanent, interest rate is temporary. So if you can get yourself a great deal, and even if you're on a pretty crappy rate, that is going to change at some point in the future. And at the moment there is only one way really that rates are going to start going, which is within the next 2 years, hopefully in a downward projection. So there are opportunities, aren't there?
Yeah, 100%. And I was just having a conversation with a client earlier about we're still quite early on into this whole chaos, aren't we, where rates went really high, and you've probably still got a lot of investors or existing landlords that haven't felt the hit of the increased rate yet. So you've got those single let landlords that in a year or two time, maybe in a year or so time, are going to have a look and think, oh no, I need to refinance and I can't afford to. Again, there's still opportunity for that, where they're going to be offloading. Spoke to someone today who's looking to buy a holiday let where the landlord is offloading, but my client is going to buy it and use a different type of strategy. They're not going to put a single let, one single family in there. They're going to try and increase the rent that property has potential to do, and so with the enhanced income that comes in, it means that the loan amount that you need, we can hit that and get 75% loan to value on that. So seeing a lot of investors trying out those different strategies other than the single let stuff, so HMOs, holiday lets and things like that. Obviously holiday lets, there's slightly less entry sort of requirements as well with holiday lets in terms of experience, so it is easier to sort of achieve a mortgage with no experience with those types of lenders. So it's
and there are a few lenders as well that will even accept it on a standard buy-to-let product as well, which massively helps. Because I think one thing we were talking about off camera was this whole idea of, okay, well, if buy-to-lets are going to be hit still pretty hard for the next 24 months, if you're an investor, what do? Do you sell, or do you pivot? Do you change your tactics? Do you look at strategies that are going to give you more cash flow in the short term? I mean, my humble opinion is, and I've said this, that buy-to-let is a long-term strategy. Property is a long-term strategy. So even if you're taking it over the next couple of years, things will come back around, and buy-to-let will come back. We've seen the rental figures go through the roof in most areas over the last few months. Rates will come back down. So that will help that sector of the market. But if you are in a position where you're really looking to grow your portfolio, you really want to start increasing your cash flow, looking at things like service accommodation, looking at things like HMO as an alternative, is where you want to be at. And I think you're absolutely spot on. Out of the two of those, the easier from a mortgage perspective to get to is probably service accommodation, because really you probably won't have to do a lot to the property to get it in a position to rent it on that basis. You don't need as much experience. Yes, the market from a mortgage perspective is not as mature as the HMO market, but it's an easier switch. I think the only difference between that and HMO is, with HMO, if you are struggling to get to the loan amounts that you need, you are increasing the rental income that will be taken into account from a rental calculator, so that potentially might help, but then you need a bit more cash to do a conversion. There's a lot of things that you need to be thinking about there. With service accommodation, there is we might have some issues in terms of getting to that loan size, but there are ways we can manipulate that in terms of rental calculators. But because lenders will still use AST income as standard most of the time, in terms of getting the cheapest rates out there anyway. So we work that into the rental calculator, so that might be a stumbling block. But for many, it could be a relatively simpler way of just starting to get some better cash flow for their portfolio. We've certainly seen a lot of our clients make that pivot, haven't we?
100%, and like you're right in saying it's all about being agile as a property investor. It's long term, long game, and you've got to get ahead of not ahead of the game, but you've got to be able to change your tactics if you need to during the course, just to get through if you are in need of cash flow. I mean, if you're someone who is in it for the long game and you're happy just to sit there and have your products on 5-year fixes and things like that, then yeah, you do you. But yeah, if clients are relying on these types of income to grow their portfolio, then yeah, massively have a look, consider, but also get educated on learning the strategy inside out, because although I'm saying it's quite an easy strategy for us to pivot and change from a standard buy-to-let product to a holiday let because of the entry levels, I think running a holiday let or service accommodation property does have a lot of work in the day-to-day running of it, especially if you're going to be the manager. Well, even if you do have a management agency, there is still loads to manage the management agency, so it's a lot. But yeah, like you said, less entry levels in terms of mortgages. But I mean, I've seen in the news this week that even in Scotland they've started to sort of change a couple of rules and regulations around holiday lets, and I think they need to have a permit in order to rent out on holiday let. So it's as easy as it is now at the moment. I mean, make hay while the sun shines, isn't it? Because I mean, if anything is to go by with Scotland and the changes they've made, then we could anticipate seeing those types of changes in England.
Absolutely, and I think, you know, on the whole, I do find that our clients, property investors in general, are quite good at sort of not predicting, but seeing what's going on in the future and sort of making adjustments to that. We've seen that with the recent sort of EPC stuff. Obviously, the government's U-turned on now, but if that is going to be something that happens in Scotland, you know, let's sort of prepare for it a little bit more. I do hope it doesn't happen, mainly actually just for our clients' sake more than anything else. It's an extra bit of paperwork to be done, but you know, and if I was an investor, I wouldn't be too concerned. You know, we've seen a few things happen in other countries outside of England that haven't then impacted what happens in the English and Welsh market, because we kind of lump those two together, don't we? You know, we've seen in Ireland, including Northern Ireland, rent controls and stuff like that. That just doesn't look like it's ever going to come into play, or should certainly in the short to medium term ever come into play in England and Wales. So yeah, you know, I'm hoping it doesn't come in, and you know, maybe they're just using Scotland as a testing ground to see the impact that it has. But you know, certainly up there, they've always been a bit different in terms of their property market. They've got different legals, they've got different surveys that they do. So look, always best to be prepared. But I do think that service accommodation is still a great opportunity. You mentioned there a couple of kind of negatives, if you like, about service accommodation, which is the management and that. I look at that as a massive opportunity. Maybe as a business owner, I see it as in a slightly different light, but I look at it as, well, if you're running a service accommodation business, you have that traditional propco, opco kind of scenario where you own the property, but then maybe you also own the management company that runs it. You can employ people, you can build a ecosystem that works with minimal input from yourself, and then you look at all of the other sort of jobs that you would outsource for. The first one that comes to mind is something like cleaning. You know, that's something that happens every single day, so you could either fold that into the management company, or you could build your own cleaning company business, or buy a cleaning company that, particularly if you've got, you know, if you've got 10 or more service accommodation properties in a particular area, it is going to work out really good for you, and probably good from a tax efficiency perspective, to own the supply chain of everything that service accommodation portfolio is going to need. So a really good idea, I think, to do that too. But look, great opportunity, and I really do hope, and as much as it hasn't been great progress, I do think that we are moving in the right direction from a mortgage market perspective with service accommodation. Lenders are slowly but surely understanding it a little bit more. We are seeing more and more lenders. I mean, we go back 3 years and there really was like one handful of lenders that would do it. That's probably now become 2 handfuls of lenders, but that's still a big increase, and hopefully you know, that will continue. Don't forget, it wasn't that long ago that if you wanted an HMO mortgage, you went to a commercial lender. You know, go back 10 years and that was pretty much the case. So as much as I hope it doesn't take 10 years to get to where the HMO market is now, I think it's getting better. It's
Yeah.
definitely getting better.
100%. And yeah, that's it. It's opportunity, isn't it? That's all it is, to allow property investors to navigate hard times, good times, and it's all good.
It's all good. Well, look, hopefully that's been really useful for you guys. As I said before, if you don't subscribe to the channel already, please do hit the notification bell to be alerted for any future videos. Shanelle and I will be back very soon with another episode. So if there is anything you want us to discuss on future episodes, drop it into the comments below, and we'll make sure to add it into our list of things to talk about. But thanks very much for joining us, and we'll see you on the next one.
Bye.